Welcome back to another stock analysis, where I'll look at some key metrics to calculate the fair value and my buy price for the stock. Today I'm going to analyze T Rowe Price. I have already analyzed another investment bank with BlackRock. So if you're interested in the BlackRock analysis as well, I have linked the video in the info card. Let's begin with looking at the revenue. Last, they generated a revenue of $7.7 billion. They have a market capitalization of $32 billion, and they are, as I already said, an investment bank. The income of T Rowe Price is generated through management fees. 62% of the revenue is made from the equity segment, which mainly consists of stock funds. The next segment is equity and blended assets, which are funds that contain both value and growth stocks. 11% of the revenue comes from multi-asset funds, which combines different asset classes such as stocks, real estates, currencies, and more. The last 2% comes from fixed income, which includes the management fees from bonds. If you want to know more about the revenue, you can check out the annual report of T Rowe Price, which I have linked down below. Enough about the introduction, let's find out if T Rowe Price is a good stock to buy at its current value. The key matrix I use to calculate the fair value and buy price for T Rowe Price is the dividend yield. I'll start with plotting the dividend yield for the last few years in a historical chart. I choose the dividend yield because a consistent dividend policy for me is the best indicator for a stable company. Additionally, a steady dividend payout helps to stabilize my portfolio, and it makes it easier to rebalance my positions. To create some sort of signal line, I take the 5 years moving average of the dividend yield and plot it in the chart. The simple approach is now that the stock seems overvalued when it's under the moving average and undervalued when it's over it. The average of the last 5 years is 2.68%, and I would like to define this as the historical dividend yield. Since the historical yield is the fundament for my fair value and buy price calculation, this value shouldn't be too volatile. In an ideal case, the curve would give a straight line. I can measure how much the curve deviates from this ideal straight line by calculating the relative standard deviation, which for T Rowe Price is 11.5%. To the historical yield, I add a personal defined margin of safety of 25%. This margin of safety will be adjusted upwards or downwards depending on the matrix of the company. My first criteria is the stability of the dividend measured with the relative standard deviation. With this value, I can measure how volatile the dividend yield is. A high relative standard deviation will higher my risk to invest at a bad timing. As I said earlier, the relative standard deviation for T Rowe Price is 11.5%. This value is inside the yellow section of my weighting scale, therefore the margin of safety doesn't change. As a dividend investor, the dividend growth of course is a very important matrix for me. In 2007, 75 cents were paid, and in 2022, $4.78 is expected. It is noteworthy that the company has paid special dividend 4 times in this period. In 2012, 15, 21, and 22. The special dividend were respectively $1, $2, and $3. T Rowe Price has paid and increased the dividend for 36 consecutive years, which makes them a solid dividend aristocrat. In the last 5 years, the average dividend growth without the special dividend was 16%. A dividend growth of 16% is quite high. It is even outside my rating scale. Therefore, I'll subtract 10% from the margin of safety for the dividend growth. By looking at the payout ratio, I'll find out if this high dividend growth is sustainable for the company. I always look at the payout ratio in respect to the free cash flow, which is the cash flow the company has available after they've paid all necessary expenses. The free cash flow from T Rowe Price has increased rapidly, from $1.5 billion in 2018 to $3.2 billion in 2021. The cash dividend were respectively $0.7 billion and $1 billion. The average payout ratio is therefore 46%. This value is in the middle of my weighting scale, and therefore the margin of safety doesn't change. Next, I'll take a look at the debt situation. The company has a debt of $0.25 billion and have $1.5 billion in cash. When the cash gets subtracted from the debt, and this value then gets divided by the EBITDA, the debt to equity ratio is found. The EBITDA is currently at $3.9 billion. But since the company has more available cash than debt, the debt to equity ratio becomes zero automatically. The debt can't be negative, therefore the numerator becomes zero, and the fraction becomes zero if the numerator is zero. Enough about mathematics. The debt to equity ratio tells us that the company could pay off the whole debt at any time if they wanted to. This is of course a sensational value, and for this matrix I'll subtract 5% from the margin of safety. The last thing I'm looking at is the growth of the company. The revenue has increased from $4.79 billion in 2017 to $7.67 billion in 2021. This gives an average growth of 12.5%. In the same period of time, the EBIT increased from $2.11 billion to $3.71 billion, which gives an average growth of 15.2%. The margin is found by dividing the EBIT with the revenue, which in 2017 gives 44%, and in 2021 increased to 48.4%. Since the EBIT increases at a higher rate than the revenue, it only makes sense that the profitability of the company increases. In this case, it increases with 2.4% in average. An EBIT growth of 15.2% is in the green section of my weighting scale, which gives minus 10% from the margin of safety. An average margin increasement of 2.4% gives minus 5% from the margin of safety. Since every matrix from analysis has now been collected, it is time to adjust the margin of safety. Minus 10% for the dividend growth, minus 5% for the debt, minus 10% for the EBIT growth, and minus 5% for the margin growth. The new margin of safety is therefore minus 5%. This leads to a desired dividend yield of 2.55%. By a current dividend of $4.78, I should therefore don't pay more than $188 for the stock. By ignoring the margin of safety, the fair price of the stock is determined, which for T Rowe Price is $178. This value can also be shown graphically in the chart for the historical yield. This is done by adding the margin of safety to the historical yield curve. This then gives a new curve, which always lies 5% under the historical yield curve. As seen in the graph, the historical yield line and the margin of safety are under the yield curve. Therefore, I consider the stock as undervalued. Finally, I consider the stock at its fair value when the price is $178. I will buy the stock at $188, and the stock price is currently at $139. If you did like the stock analysis, please consider to give the video a like, let me know in the comments which stock you would like to see next, and subscribe to my channel for weekly content.